Hello, and welcome to Credit Careercast, brought to you by Highako. This week, Bob Shultz talks with Bruce Lynn of the FENG, the Financial Executives Network Group, to discuss the role of Treasury in your company's success. We hope you enjoy this conversation. Let's get right into it.
Hey, Bruce, I've been looking forward to this conversation for a long time. You know, you are a member of one of the most valuable networking groups I've ever encountered, the Financial Executive Networking Group, and you've been in Treasury for a long time. Why don't you tell me a little bit about the Financial Executive Networking Group, FENG, and how you think your role has changed as in Treasury over the time of your career?
All right. Well, thank you, Bob. And let me talk a little bit about the network first, and then how myself and my career were sort of fit into that. The FENG, the Financial Executives Networking Group, it's about 33,000 people, all financial professionals with 15 or 20 years of experience. We're divided into special interest groups by either industry or by subject matter expertise. I happen to run the Treasury group, given my background. So it's a really valuable resource when you're trying to ask your questions, and if you haven't done a lot of things before. And again, I think that I've done a lot of things, but I'm also smart enough to admit that I don't know everything. And so when you don't, where do you go to ask someone who's been there and done that? I mean, my career started back actually on the banking side. I've worked at banks. I've also worked at non-financial corporations. And right now I do Treasury consulting. So I've seen Treasury from what I'll call both sides of the desk. I actually sold cash management services for a bank. I also ran a credit and collection department. So I've been on the corporate side, the banking side, and again, on the consulting side, I often feel like I'm the man in the white striped shirt on a football field, trying to referee and making sure that both sides, the bankers and the corporates, are playing by the same set of rules, and trying to point out a little bit about sometimes how you play the game, which is unfortunate. And we'll come back to that a little later on. But I have an engineering background as well as an MBA in finance, and I find a lot of the talents and skills as an engineer actually apply to the financial world, especially in the whole area of value at risk, which was a set of statistical techniques that have been used on the production line to ensure quality control. You want to make sure that the widgets coming off the line are within tolerances. Today, you want to make sure that, let's say a portfolio of foreign exchange holdings are within tolerances, or you should be buying or selling something. So a lot of things are the same in terms of risk being important, but things have changed also in terms of interest rates. In the old days, interest rates were a lot higher than they are today, and you don't have to go too far back to know when LIBOR was up around 6%, and of course higher than that if you want to go a little further back. And now those rates are heading up, and of course LIBOR is disappearing. So the more things change, the more they remain the same. I think one of the big differences, however, is technology. If I were a cynic, I would just say that technology has allowed you to make your mistakes faster, which is never a goal. But you do have technology that you did not have before. So there are tremendous advantages in being able to really dive deeper into the trends that you see, and if done right, come up with some decisions that make a lot of sense.
Well, that's very interesting. So the role has kind of evolved as technology has evolved, it sounds like. So what is the basic value for people that don't know a lot about Treasury? What is the basic value that a Treasury department or a treasurer brings to the company? What do you think is the most important aspect of that value?
Well, being a treasurer of a large company, public or private, I think has one giant advantage over many functions, financial functions within a company, is that a treasurer needs to have what I would call sort of an outside-in view of the company. The business of treasury is liquidity and risk. The whole idea of it's 9 o'clock in the morning, where in the world's my cash? Or how much liquidity is enough? Or how much risk is too much? But these are all relative questions. There is no absolute answer to any of those questions. But if you decide for whatever reason that you don't have enough liquidity, where do you go? Well, you have to go outside of the company, a bank, the capital markets, wherever. And you have to look at your company the way a lender would look. I mean, you're borrowing, could be equity, whatever, going into the capital markets. You have to understand what your company looks like from their perspective. So you know what is negotiable and what is not. And you want to bring back that extra liquidity, borrowing $100 million for 5 years, whatever, so that you can match sources of funds with uses of funds. So the treasurer is very market oriented, perhaps more so than just understanding about credits and debits. Not that that's unimportant, but again, you have to understand market forces, who you're doing business with. These are what I'll call sort of an outside perspective. And again, bringing that into the company gives the company a feeling about, quite frankly, what is possible and what is not. I mean, the whole question about how much risk is too much, again, no right answer to that. But if your counterparty thinks you are too risky, then you are, no matter what the CEO thinks. And many companies have been done in by a too narrow perspective on risk.
So a treasurer has oversight over the borrowing aspects of a company and banking relationships and the need for borrowing in the first place. So I've spent my career in order to cash management, credit collections management. So what do you see as the overlap? I mean, that's where the cash flow comes in, is through that function. How is the overlap there?
There's definitely an overlap, and I think that the process, if you will, where the overlap is clear, is the whole cash conversion cycle, because it's, I think, true that if you want to reduce your borrowings and you still want to build that widget plan, where does that delta come from? Where does that cash come from? That is your operating cash flow. And who has an influence on that? Actually, not Treasury, because operating cash flow comes from the business units that are selling widgets to customers, so that hopefully when they pay, the cash coming in is more than the cash going out. Again, all part of a cycle. And so who's leading that charge? Well, it really is credit. I mean, when you think about it, if the Treasury Department is in charge of borrowing from outside sources, credit really is in charge of lending. I mean, you're lending that company's cash by investing it in the widgets that you sell to the customer. You create accounts receivable. At banks, they call them loans, but in non-financial companies, they're accounts receivable. You still have to collect on them, and you still have to collect them on time. So there's a tremendous parallel. You're just really on a mirror image of whether you're a borrower or a lender. I think credit and Treasury need to play well together and play more closely together.
It sounds like a key aspect of that is accurate cash forecasting. So there's two sides of the coin on cash forecasting. There's the inflows and estimating what those will be over different periods of time. And then there's the outflow. So what's the role of the treasurer in kind of having their foot on both sides of that?
Well, there are differences, of course. The credit department is very much concerned with what I'll call inflows. Obviously, making a credit decision, the idea that you're going to spend future monies. But the credit department is more concerned with accounts receivable. Treasury is concerned with other parts of that cash conversion cycle, not only what's coming in, but what's going out. and if there's a shortage, how much, in what currency, when. These are concerns that treasurer has. But again, you're in a different part of that same cash conversion cycle. So the two people really do have to play together. If you can borrow less, I don't care if the rates are low or high. If you borrow less, it costs you less. It's just like having a car that gets better gas mileage. You're a little bit more immune to the forces you can't control, like the price of gasoline or interest rates in this case. So again, having those linkages. You talked about forecasts. I mean, Treasury is very much involved in the cash forecasting business, short term as well as long term. Sort of the classic 13-week rolling forecast. Well, how do you make that more accurate? Working with credit certainly is a way to know that, because you want to know who's going to pay, which customer is going to pay, and when. Longer term forecasts, to be honest, credit plays a slightly lesser role there, because when you look out further, 90 days, a year, 5 years, you're really looking into that market about what you're going to buy and what you're going to sell, and widget plans. Again, credit plays a role here, because if the customers are complaining about the quality of the product, maybe it's time to reinvest in that new widget plan. So credit does have a tremendous advantage, being sort of at the end of that pipeline, to look all the way up towards sales and see sort of what's going right and what's going wrong, and to communicate that to other areas in the company is just a better way of running a company.
I'm going to throw you a little bit of a curveball here, Bruce. My consulting for the last almost 20 years now has centered around order to cash, credit collections, that area. You're consulting into Treasury. I've walked into some major horror stories that had to be dealt with, where the process, procedures, the way people are deployed, the systems were just inadequate, and they had to be fixed. What would be an example of one of the horror stories that you walked into as a consultant, and how do you fix that?
Well, I have an interesting story about that. Back in the day when I was working for a Fortune 500 company, we had one customer. Again, this is a multi-billion-dollar public company. We had one customer represented about 5% of the top line. They were, what's a technical term? A pain in the butt.
That's technical. That is technical. Yeah.
Yes, that's highly technical. They wanted everything. They didn't want to pay. And eventually what happened, the decision was to kick them out, boot them out of the lifeboat, not to fix things. And were we offering a bad service? No, we weren't offering a bad service. They were just, how do I say this nicely? They were a bad customer. I don't want to mention any names, but so we basically got rid of 5% of our sales. Bottom line, no impact. In fact, we probably made a few bucks. So I think this is where credit and treasury really have to work together to understand what is possible. And sometimes it isn't fixing what you have. What you have is good. It's the other guy. It's the counterparty risk. And if they're they're taking their half out of the middle, maybe it's time to get rid of them and find some other customers that are more profitable. As I used to say, there's nothing worse than a low margin customer that pays late, especially in a higher interest rate environment. So I think we talk about sort of metrics and how you figure that out, but that was a decision to actually tell them to go away.
It's really interesting you'd say that. I've always encouraged companies I've worked with and clients to look at particularly your major accounts or certain channels. And what's the profit? What's, after everything is said and done, what is the net profit on that company? And is it really worth retaining them, or should you go somewhere else? And it could be a channel of sale that has such low profitability and such high risk that it's just worth it to pass it on to distribution, for example, that can deal more directly with that channel. That would be an example, but I think you raise a really good point. Is what at the end of the day, are you really making money? There's other motives. I mean, to keep competition out, maybe to retain some presence in a particular country or region. There's other business motives, maybe, but if you're not making money, you may even be losing money. You really have to analyze that and then make a judgment. Do we really want to continue with this, or should we move on to an area where we really can do more benefit to our company? It's interesting you would bring that up. That's a big deal in my world.
Well, it is. And we can talk maybe a little bit more about the whole concept of what I would call risk-adjusted return on capital, which is known as RAROC in the banking world. These kinds of metrics, or that principle, is sort of embedded in many of the regulations that banks have to deal with. But the concept of risk-adjusted return on capital is not something that you hear much about in what I'll call the non-financial companies. Certainly return on capital, return on assets, these are not unknown concepts in the non-banking world. But risk adjustments, again, you could argue about how you do that, because risk is it can be very amorphous. It's not like a debit or a credit. It's something that is basically unknown. The probabilities of this happening or something. But you do have to concern yourself with risk if you really want to, quote unquote, make money.
Yeah. So let's say that I'm somebody starting my career. I want to go into a financial area, and I learn a little bit about Treasury, and wow, that's an interesting role. How would somebody in that situation prepare themselves to go into a role in Treasury and ultimately become a treasurer? What would you suggest for that type of situation?
Well, it's interesting. I mean, in my career, again, I had an engineering background. I think in college I had one accounting course. It's accounting for engineers, pretty basic. But you certainly do have to be able to talk, credits and debits. You have to understand accounting. But as you get into the business world, I mean, one of the great courses I had when I was going through my MBA schooling was what I'll call the case of the unidentified industries. The ability to look at different parts of the company, but to look at also the company holistically, to understand about profitability and cash flow and risk or financial leverage. And every industry has different characteristics. I mean, it's well known that the food industry has low profit margins, where the fintech world has, quite frankly, very high profit margins. Asset turnover, so on and so forth, return on capital. Each of the industries are different, but the emphasis on cash flow, I think, is something that, just like everything else, people have an affinity for it. Certainly there are people who look at profits, but another story that I have is a company I used to work for. Every year they would have an annual meeting. They would talk about sales, and the next year they would be talking about profits. But by the third year, they were talking about, where's my cash? So you can't forget that liquidity part of it. And for people who want to know more about managing liquidity and risk, which is the business of Treasury, there are organizations that offer training. I happen to possess the Certified Treasury Professional Credential, CTP. So for those who are interested in moving toward the Treasury world, I think that is certainly a good credential. It does not replace practical experience. And I'll show you the scars later on about what I learned. But in terms of formal schooling, that is one area that those people who want to know more about liquidity and risk, I think it's a good credential to have.
I'll put in a little pitch for the Highako Academy here. One of the key aspects in credit management or treasury you brought it up, and that's the cash conversion cycle. That's an incredibly important concept. And in order to manage through the different parts of that process, you have to kind of understand business. You have to understand how all the various parts fit together and how they interrelate and the best way for them to manage the entire process. And so with Highako, what we're aiming towards is to help people kind of understand all of those pieces and how they fit together. And I think that's an important thing. I mean, people, unfortunately, in my experience, people that graduate with business degrees are, they're great. They can do spreadsheets really wonderfully. They're very smart. They can take on a project, but they haven't really been acclimated to, what are the different components of a business and how do they fit together? So one of the wonderful things about both of these careers is that you get a thorough understanding of business, and these are business functions. These are not accounting. They're not tic-tac and toeing. They are business functions that really, at the end of the day, deliver some great value to the overall needs of a company. You agree with that?
Well, I would agree. I think that in the beginning, and again, it depends on where you are in your career. In the beginning, you are probably undertaking more tactical activities. Obviously, learning sort of where the credit department is, on which floor it's at, and who to talk to in accounting and auditing and tax and all the other financial functions, as well as the business units. I mean, you have to never forget that it is all about selling product to customer or selling services to customers. So the customer is the ultimate profit center. It's not division A, it's not division B, it's that customer. And if the customer walks, in most cases, it affects many parts of the corporation. But as you grow in your career, if you really are going to add value to the corporation, you have to, how do I say this nicely? But you have to maybe do less processing and more planning. You have to, again, look out sort of over the horizon to see what's coming up, as opposed to just merely sort of fixing things. Maybe you should be preventing things. And this is the whole concept of risk. And I would argue that's really a key attribute of credit management, is evaluating risk and being able to take the proper risks. No risks? No. You shouldn't be in business if you want no risk. So you have to take some risks. The question is how much risk to take. And that's a question that goes from the lowest level, someone right out of school, up to the board of directors. And the business world is full of companies that have taken too much risk and quite frankly don't exist anymore.
Well, and it also requires, and I think one of the most attractive things about these roles is that you need to understand competitive issues. You need to understand kind of macroeconomic issues. You really have to keep your eyes and ears open. You say, looking at long term, you have to be able to predict certain things based on what the outside world is doing. So it's not just working within the confines of your company. It's really understanding a lot of these other things. It also requires an understanding, another mantra of mine. It requires an understanding of what are the company's objectives? What are you trying to do in the marketplace? What type of profitability are you looking for? And you've touched on a couple of these things. How much liquidity is too much, how much risk is too much or too little. To understand those things, you really have to understand the overarching objectives of your company, don't you think?
No, I agree. I mean, there's a saying that's been attributed to Peter Drucker, one of the great management consultants, about what gets measured gets managed. So when you're looking at the company, you have to understand what success is. Again, I go back to the engineering world. As long as your widgets are coming out and they're between these two levels, not too big, not too small, as long as they're between those levels, go home. You're under control. Now, again, there's techniques you can use to determine whether that's permanent or just one time, but that's what you have to do with business, which is decide how much risk you wish to take. I mean, there are rules. I mean, Sarbanes-Oxley, for example, was created because it was suddenly discovered that they were not financial experts on the audit committee. So you had rules that said that you really need, a finance expert on certain committees. So you want to make an overt risk decision as opposed to a covert risk decision. I mean, you want to bet the ranch, fine, bet the ranch, but know that you're doing that. And so I think that is something that is constantly, should be constantly in the background as you make decisions. I think from a career perspective, you will be zigging and zagging throughout your career. And it's nice to think, and then some people can do it. They go from A to B with no side trips. It's really rare. Some people do it, but I think you just have to understand sort of where you are in relation to where you wish to go. And that requires some sort of metrics. It's true for people. It's also true for companies. It's also one of the bête noirs of Treasury is that trying to measure Treasury success is often difficult and sometimes not even done, which means that Treasury is going to have a hard time asking for more resources if you can't demonstrate success.
So we have a couple minutes left, Bruce. Let's focus on kind of a go forward look here. What do you think the greatest challenges facing the Treasury area are over the next couple of years, and how do you think that will affect the role?
Well, I think the challenges are, and one of the challenges is actually just having success metrics. I mean, this being a capitalistic society, you want something done, you got to pay for it, but you also want to know whether you're being successful. And Treasury often does not have success metrics. There are some that we can talk about maybe in a later podcast, but I think you need that, and there should be a bonus plan paid to not only Treasury but to any of the organizations in the company that generate cash. It makes the company's success more probable. In Treasury today, you have to keep learning. You can't rest on your laurels. You have to work with other elements of the company. You have to train. I mean, rules, regulations, compliance, market forces are constantly changing. So that is the challenge, is to keep up with that. And that requires, I'm going to say, going back to school, but also networking with others who have been there and done that. There are many people and many things that need to be known. And so if you can't do it yourself, if you can't make it, then you have to go out and find it. And knowing when to do that is really important.
So networking, continuing education, the ability to really evolve, not remain static, not be too comfortable in your role, but to always look at what's coming next. That's really what you're describing, isn't it, Bruce?
It is, and again, I come back to the idea of success metrics. I mean, don't let perfect get in the way of good, as they say. You have to know, when you have done a good job. Again, exactly how you do that, that's maybe a little bit more time than we have available, but that is something that you have to consider, because you just have to consider that it's now time to use your resources wisely and move on to another issue if you have quote unquote succeeded.
Everyone in these roles is kind of looking at bots. How is that going to affect my role? Is it going to eliminate the need for my role? And then the other thing is, virtual currencies, how is that going to impact Treasury and so on? I mean, both of these things are probably for another session, but you agree these are primary concerns that people need to understand and maybe adapt to?
Yes, I do have a bias about cryptocurrencies, and which is that the last thing the world needs is another currency. There's what I think 170 countries, and there's 170 currencies out there. So whether they're real or virtual, I think more currencies is not necessarily better. But my concern with cryptocurrencies, and maybe they're in their infancy, but they are too volatile. I mean, why do you want to get paid in a currency that is worth X today and X minus tomorrow? That's a gain or a loss that has to be recorded on your P&L. But even more importantly than the value of the currency is who's holding it. I trust the major banks to hold my cash because if I ask for it back, it's going to be there. I'm not sure I could say the same thing for some of the repositories today that, quite frankly, they've all been hacked. So you think your wallet's here and it's gone.
Definitely some questions that should be asked if anyone listening is encountering thoughts by senior management of engaging with this. So we're about out of time here, Bruce. Any last thoughts that you'd like to pass on to the listeners here?
Well, I think that you have to be conscious of your career and how it fits into to where the company is going. Certainly, things should be in parallel. And as we mentioned before, I think constantly learning, having that built-in curiosity about not only how something happens, but why and what. You want to be able to work in an environment that, quite frankly, is fun. I mean, the end of the day, you want to. Life is too short to be to be unhappy. What's the old saying about no one's ever said, "Damn, I wish I had one more meeting before I die." No one says that. So if you're not having a good time where you are, you have to be able to affect that. And I happen to think that Treasury is one of those areas that you can constantly learn. So I'm sort of happy that I've picked that as a skill set. But whatever the skill set that you pick, you should be happy with it.
Boy, I sure agree with you. I mean, these terms may sound dry to somebody first hearing them, but these are very fun occupations. They're very challenging occupations. And you know what? They add great value to your company, and that's pretty rewarding. With that, we'll end it. Bruce, thank you so much.
Well, thank you, Bob.
It's been an interesting conversation. Really appreciate it.
Thank you, everybody, for tuning in. If you want to learn more on the topic, check out Highako.com.